If you've ever looked at a Social Security break-even chart, you've probably seen some version of this. Claim early, get more money up front, wait longer, and you quote unquote win if you live past a certain age, usually somewhere in your 80s. But there's a strange kind of double think in this process that almost no one talks about. People build their retirement plans around negative risks, things like sequence of return risk, recessions, bad luck, but then turn around and make their Social Security decisions often based on much rosier assumptions. It's like buckling your seatbelt for safety and then texting the whole drive. In this video, I want to unpack why so many retirees get trapped in this sort of contradiction and why you might want to completely rethink how you interpret a Social Security break-even chart. Let's walk through the traditional way a lot of retirees, but also advisors, look at Social Security break-evens. Typically, arguments center around two main issues. When are you going to pass away, and what rate of return is your portfolio going to earn? On the screen, I have a couple that is retiring right before their 62nd birthdays. Both have reasonable Social Security benefits. Now, we have the male passing away at age 83 and the wife passing away at age 85. We are then assuming a portfolio rate of return of 3% on top of inflation. Based on these variables, we find the optimal filing ages to be in between fully delaying, but also in between taking Social Security immediately. Now, some of you might be looking at these assumptions and think they're quite reasonable. Others might find certain assumptions are too aggressive, or some might even find they're too conservative. What's more, if we start to play around with these assumptions, we find they're pretty fragile. Extend life expectancy by just a couple of years, and we might find that delaying for both to 70 would win. Raise the portfolio return a few percent, and all of a sudden filing earlier wins. And both of these assumptions are truly unknown, so arguments for changing either of these seem quite valid. But this isn't the only problem. It's entirely true that we want to consider portfolio returns when making Social Security decisions, but these break-even charts use portfolio returns in a fundamentally flawed way. They assume straight line returns. If inflation is 2.5% and our portfolio return after inflation is 3%, then this process is just going to assume that we have a straight line returns of 5.5% each and every year. We know, however, that portfolio returns are volatile, up 20% one year and down 10% the next. This is quite different than how most people, advisors, and retirees alike plan their spending in retirement. For instance, the 4% rule, or the framework behind the 4% rule, is a very common approach. Now, what is the 4% rule? Well, it was a study done by a financial advisor in the 90s, and they were trying to answer the question for how much a retiree could safely spend each year in retirement. They ran a study looking at a balanced portfolio over a 30-year retirement. 4% was found as the safe withdrawal rate because that was the highest withdrawal rate one could take in the worst case historic simulation. Now, if you just look across all historical simulations, you'll see that the average withdrawal rate was somewhere in that 6% range. But you'll notice we don't call this the 6% rule. It's called the 4% rule. Why? Because the 4% rule, and really retirement planning as a whole, isn't built around average outcome. It's built around making sure retirement stays intact even through the poor outcomes. Now, I'm not saying everyone follows the 4% rule exactly. We certainly don't. But most retirees use a framework based on a similar foundation, one that sets spending based on, let's say, the bottom 5 to 15% of historical or simulated results. In other words, they're intentionally planning for bad luck, not good luck. But this creates a strange kind of dissonance in how we view different parts of a retirement plan. When we look at the income plan, we use quite conservative assumptions. We don't know what kind of market we're going to retire into, so we make sure we're prepared for the worst. We don't know exactly how long we're going to live, so we generally assume we're going to live longer than we first might expect. Yet when it comes to Social Security, most people flip the framework entirely. They plug in relatively optimistic or average portfolio returns in their break-even calculations. Often they pick a specific life expectancy as if they know the exact date on the calendar. They plan one part of their retirement for chaos and another part as if the world is perfectly predictable. So what I want to propose in this video is quite simple. What if we use a consistent framework across all of our retirement decisions? Because once we do, we start to see that break-even charts, beyond being mathematically fragile, are also conceptually flawed. They tell us when a line crosses on paper, but not which decision actually supports our spending best. And I think ultimately that's what most people care about in retirement, maximizing safe spending. Retirement planning tools have come a long way in recent years. We don't have to rely on oversimplified break-even charts that assume some straight line return and force us to pick assumptions out of thin air. For example, one of the softwares that we use for our clients allows us to take a retiree's exact situation and run it through actual historical markets. One of the biggest critiques I have of the 4% rule is that it's way too general. It only tells you what a portfolio could have historically supported if that portfolio were your only income source. But real world retirees obviously aren't that simple. They have Social Security, some have pensions, some have income that starts and stops at different times. This type of analysis lets us do something far more realistic. It runs a 4% rule style test, but tailored to one's actual situation. We're not projecting a single tidy return line. We're replaying history with all of its volatility, inflation shocks, and bear markets included. On the screen, I have an example. A retiree with $1 million portfolio invested in a 60-40 mix and receiving solid Social Security income depending on when they file. In this chart, we're looking at them filing at age 62. The black line here represents their spending capacity, how much their plan could have safely supported over history. Now, know that the spending capacity can be adjusted depending on one's risk tolerance. A conservative retiree might stick close to the worst case outcome, something like a 4% rule style benchmark. Someone more flexible who's willing to adjust spending later in life if needed might target a 90% historical success rate, which is more or less what I'm showing here. Now, I wish I could overlay two versions of this chart, one where we have somebody filing at 62 and another where they delay to 70, and show you how those different spending capacities differ year by year. I can't do that cleanly with the software, unfortunately, but let's walk through a few examples or snapshots that illustrate how these differences actually play out in the real world. First, let's look at a great starting point for retirement, June of 1981. The 80s and 90s were phenomenal decades for investors. High interest rates early on, strong equity returns, and ultimately one of the best sequences of returns that, frankly, we've seen. If you retired then and filed for Social Security at 62, your spending capacity based on the situation would have been roughly $600 per month higher than if you delayed till age 70. Why is this the case? Because portfolio returns were so strong in this simulation that they completely outpaced the benefit increase from waiting to claim Social Security. So when people run break-even analyses and they're using rosy assumptions like 6, 7, 8% real returns, what they're really saying is I'm planning my Social Security strategy as if I'm retiring in 1981 or something similar. Next, let's look at something more middle of the road, November of 1952. Portfolio returns in this period were more average, not really great, but not terrible. Inflation was moderate and sequence of return risk wasn't extreme in either direction. In this case, the results were effectively a wash. Filing at 62 or waiting until 70 both supported more or less the same level of sustainable spending over time. There's no clear winner. And finally, let's look at a tough one, June of 1965. This was one of the more challenging starting points over the last century. A retiree starting would have faced nearly a decade of high inflation and poor real returns, a brutal combination early in retirement. In this scenario, filing at 62 would have supported roughly $400 less per month in sustainable spending as compared to delaying until 70. This is because when portfolio returns are low or volatile, the guaranteed income and guaranteed benefit from delaying Social Security becomes more valuable. It shores up the floor of your plan and gives your investments more room to recover later on in retirement. And this is where, again, we see some real dissonance in how people make decisions in retirement. Retirees often set their spending expectations based on conservative assumptions, preparing for lower returns and tougher markets, but then make their Social Security decisions using an entirely different framework. As we just saw, there's no single right answer for when to file. It's not like one strategy wins across every historical scenario. There are always going to be trade-offs here. But if we want to be consistent in how we make our decisions across our plan, the data here suggests that delaying, at least to some extent, tends to be a more prudent choice, at least for this couple. Why? Two reasons. First, this couple's spending capacity is already set around conservative expectations. So it makes sense to optimize for what helps in those conservative outcomes. And in almost every case, delaying Social Security lifts spending capacity in those same tougher scenarios. Second, there's also a utility of money argument here as well. The extra $400 a month this couple could spend in the bad scenario by delaying is far more valuable than the extra $600 a month they could spend in a great scenario by claiming early. In that good scenario, everything's already going right. Markets are strong, portfolio growth is high, life feels extremely comfortable. That extra income from filing at 62 really won't move the needle that much. But in the tough scenario, when inflation's high, returns are low, and confidence is completely shaken, that extra $400 per month from delaying Social Security makes a real difference. Think of it like this. Having an extra $100,000 when your portfolio is $1 million feels a lot more impactful than having an extra $1 million when you already have $10 million. Even though both are just a 10% gain, the first one matters more because of the utility of money. And this is what we see from running a lot of Social Security decisions from a historical spending capacity point of view, or even a simulated spending capacity point of view. In many cases, assuming you aren't certain you're going to pass away in your 70s, delaying Social Security allows for a larger spending floor while sacrificing a little bit of that ceiling. This puts Social Security decision making in a completely different context than the break even analysis would. And as is my case in this video, this new context ends up being more realistic and consistent with how you are making other decisions in retirement. Because the real goal isn't to quote unquote win a break even chart, it's to create a plan that keeps your lifestyle stable and your confidence high no matter what kind of market you retire into. Now, to be clear, my case isn't for everyone to delay Social Security until age 70. As we've gone through these charts and examples, I couldn't obviously realistically show every possible filing combination or every nuance of timing. So I chose to highlight two extremes, filing early at 62 versus delaying till 70. Every retirement, however, is unique, not just in the financial details, but in goals, health, and risk comfort. Some retirees, because of current health conditions, have a clear expectation that they won't live into their 80s and their 90s. That will obviously change the best filing strategy and their sustainable spending levels. Others might simply want to plan more optimistically, accepting a higher probability of an adjustment later in life if things aren't going as well in exchange for higher spending now. That's perfectly reasonable too. My case in this video is really twofold. First, be consistent in how you make decisions across your retirement plan. Don't build your income strategy around really conservative assumptions and then turn around and make your Social Security decision based on a completely different set of rosier assumptions. When you do that, your plan becomes disjointed. Second, rather than relying on fragile break-even charts that force you to pick assumptions out of thin air, use a process like what I showed here. One that looks at historical spending capacities or simulated spending capacities and integrates your actual financial picture. Because yes, every filing strategy involves some level of trade-offs, but as we've seen, those trade-offs aren't equal. Hopefully this helped you think a little bit deeper about how you're approaching Social Security, not just as a standalone decision, but as a part of a bigger story. If you're looking for help to incorporate some of the ideas in this video in your retirement plan, reach out and see if our team can help. Just a quick note on this front, since joining Merit, our team has been able to expand capacities and lower our minimums for viewers on this channel. If you're interested in exploring working with us, use the link or phone number in the description below and mention that you've been watching our YouTube channel. If you call Merit's main line or fill out a general form, you might be paired with a different advisor who may not share our exact planning philosophies and may charge higher fees. Using the link below ensures you connect directly with our team. Thanks for watching today's video, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.